Welcome to Stock Market Investment Strategies. I'm your host, Evelyn. Today, we dive into the fascinating world of stock market investing, where every decision can shape your financial future. Joining us are our esteemed guests who will share their insights and expertise on navigating the complexities of the market. Let's explore the art and science of investment strategies together. Sophia, let's start with you. Could you break down the concept of value investing for our listeners?
Absolutely, Evelyn. Value investing, in its essence, is about finding stocks that are undervalued by the market. These are shares of companies that are priced below their intrinsic value. The idea is, over time, the market will correct this undervaluation, leading to potentially high returns for the investor who recognized the stock's true value early on.
That's a great explanation, Sophia. It's like searching for hidden gems in a vast sea of stones. Warren Buffett, a proponent of value investing, often talks about the margin of safety, which is basically buying these undervalued stocks at a discount. This approach minimizes the risk of loss.
Exactly, Michael. But it's also important to note that identifying these undervalued stocks requires a lot of research and analysis. Investors need to look at a company's fundamentals, like its earnings, debt levels, and management quality, among other factors, to gauge its real worth.
It sounds like a thorough understanding of a company's business and the market is crucial. How do you both suggest beginners approach this?
Beginners should start by learning how to read financial statements and understand basic financial ratios. But equally important is developing patience. Value investing is a long-term strategy. Sometimes it takes years for an undervalued company's stock price to reflect its true value.
I'd add that starting with industries you're already familiar with can be helpful. If you understand how a business operates and what makes it successful, you're in a better position to judge its value. And there are plenty of resources out there to guide you through the process.
That's solid advice. So patience, research, and a bit of personal insight into industries. With markets being so volatile, how do you maintain confidence in your value investing strategy?
It's all about staying the course and keeping your emotions in check. Market volatility is normal, but the fundamental values of solid companies don't change as rapidly. It's those fundamentals that value investors bank on, not the short-term market fluctuations.
And diversification can help manage the risk. Even the most thorough research can't predict everything. Having a mix of investments can mitigate potential losses without sacrificing too much potential gain.
Diversification and a strong emotional fortitude seem key to succeeding with value investing. Shifting gears to day trading, which is on the opposite spectrum of value investing, how do you see beginners navigating this fast-paced environment?
Day trading is definitely a whole different ballgame. It requires a keen understanding of market trends and the ability to make quick decisions. For beginners, I recommend starting with a simulation or a paper trading account to practice without risking real money.
Absolutely, Sophia. And let's not forget the importance of a solid trading plan. Day traders should have clear entry and exit strategies for each trade and stick to them to manage risks effectively.
Sounds like discipline is crucial. Considering the quick pace, how important is technology in day trading?
Technology is essential. Having access to real-time market data, advanced charting tools, and quick execution platforms can be the difference between profit and loss. It's vital for day traders to use the best tools available to stay ahead.
I'd also stress the importance of keeping abreast of news. Day traders need to react swiftly to market-moving news. Sometimes, the software that provides news alerts and enables quick trades becomes a trader's best friend.
Reacting to news quickly suggests that day traders need to be well-informed and always on their toes. How can one avoid the stress associated with such a high level of alertness?
It's all about setting limits, knowing when to step away for the day, whether you've hit your profit target or your loss threshold. Mental health is just as important as financial health in day trading.
Plus, having a strong network or community of other traders can provide support and insights. Sometimes, sharing strategies or discussing market movements with peers can alleviate some of the stress and help refine your approaches.
Shifting gears to a more long-term perspective, let's talk about diversification. How crucial is it to diversify one's stock portfolio?
Diversification is key. It's about not putting all your eggs in one basket. By spreading investments across various sectors or asset classes, investors can reduce the risk of significant losses if one sector underperforms. It's a fundamental risk management strategy.
Right, Sophia. And it's not just about investing in different stocks. True diversification involves a mix of asset types, equities, bonds, real estate, and even commodities. Each reacts differently to market changes, providing a buffer against volatility.
Can you provide examples of how diversification has helped investors in the past?
Sure, during the dot-com bubble burst in the early 2000s, those who had diversified portfolios were better shielded against the massive downturn in tech stocks. Their investments in other sectors or asset classes helped mitigate losses.
And more recently, during the 2008 financial crisis, assets like gold and certain bonds saw an increase in value, which could have helped balance out the declines in stock values for diversified investors.
It's clear that diversification can be a safety net during turbulent times. How does one decide the right diversification strategy for their portfolio?
It largely depends on the individual's risk tolerance, investment timeframe, and financial goals. A young investor might lean more towards stocks for long-term growth, while someone closer to retirement might include more bonds for stability.
And let's not overlook the role of international diversification. Investing in markets outside your home country can offer growth opportunities and further spread risk, especially considering geopolitical events or regional economic downturns.
With the global economy becoming more interconnected, international diversification sounds like a smart move. Are there challenges to this approach?
Definitely. Currency risk and geopolitical uncertainty are two major challenges. The performance of international investments can be affected by changes in exchange rates and political instability.
However, these challenges can be managed with thorough research and sometimes by using financial instruments like ETFs, exchange-traded funds, that offer diversification across various countries without the need to directly invest in foreign markets.
ETFs sound like a convenient tool for achieving diversification. How do investors determine the right mix of assets within their portfolios?
There's no one-size-fits-all answer, but many turn to the modern portfolio theory as a starting point. It suggests an optimal mix of assets based on expected returns and risk, aiming for the highest possible return for a given level of risk.
And don't forget, continuous review and rebalancing of your portfolio is essential. Market conditions change, and so do personal circumstances. What works today might not be ideal tomorrow.
Speaking of changing market conditions, let's dive into technical analysis. How can investors use charts and technical indicators to navigate these changes effectively?
Technical analysis is all about identifying trends and patterns in stock prices that can help predict future movements. By analyzing past market data, such as price and volume, investors can make more informed trading decisions.
Right, and it's not just about looking at charts. Technical analysts use various indicators, like moving averages or relative strength index, RSI, to gauge market sentiment and momentum. This can be especially helpful in volatile markets.
Exactly, and it's interesting to note how different indicators can serve different purposes. For instance, moving averages can help smooth out price data to identify the trend direction, while RSI can indicate whether a stock is overbought or oversold.
So, it sounds like a combination of these tools can give investors a clearer picture of the market's direction. How do beginners start to incorporate technical analysis into their investment strategies?
The key is starting simple. New investors might begin with basic trend lines and moving averages to understand the general direction of market prices. There's a wealth of resources and tools available online to help beginners get a grasp of these concepts.
Also, practice makes perfect. Using demo accounts or simulators can allow beginners to apply technical analysis without real financial risk. It's an excellent way to build confidence before diving into actual trading.
That's a great suggestion. Practice can definitely help demystify the process. How important is it for investors to stay updated with technological advancements in trading platforms and tools?
Incredibly important. The field of technical analysis is evolving rapidly with advancements in AI and machine learning. New tools and platforms are making it easier and more efficient to analyze vast amounts of market data for better decision-making.
And with these advancements, staying informed and adapting to new tools can provide a competitive edge. It's not just about analyzing past data anymore, but also about predicting future movements more accurately.
It seems like technical analysis, when combined with an understanding of market fundamentals and continuous learning, can significantly enhance an investor's ability to make informed decisions.
Absolutely, but let's not overlook the importance of fundamental analysis here. It's one thing to understand the market's technical direction, but analyzing a company's fundamentals is crucial for long-term investment success. Would you agree, Sophia?
Definitely, Michael. Fundamental analysis provides the bedrock for any solid investment strategy. It helps investors understand the intrinsic value of a company by examining its financial health, competitive position, and the potential for future growth.
So, in a way, fundamental analysis is like getting to know a company inside out before deciding to invest in it.
Precisely, Evelyn. It's about looking beyond the stock price fluctuations and understanding what drives a company's performance. Metrics like earnings per share, EPS, price to earnings, PE ratio, and debt to equity ratio, among others, are pivotal in assessing a company's financial health.
And let's not forget the qualitative aspects of fundamental analysis. Evaluating the company's management team, its competitive advantages, and industry trends can provide insights into the company's potential for sustained growth.
It seems there's quite a bit of detective work involved in fundamental analysis. How can investors sift through this vast amount of information efficiently?
That's where having a systematic approach to research comes in handy. Start with the sectors and industries you're familiar with or interested in. Use financial news, company reports, and sector analyses to build a comprehensive picture.
And technology plays a role here too. Many platforms now offer analytical tools that aggregate financial data and provide ratings or insights, saving investors a considerable amount of time.
Therefore, combining the rigor of fundamental analysis with the insights from technical analysis and leveraging technology seems to be a comprehensive approach for modern investors.
Absolutely. And let's not forget the importance of a diversified portfolio. Balancing investments across different sectors and asset classes can help mitigate risk and improve potential returns over time.
Speaking of mitigating risk, one cannot overstate the importance of understanding the concept of portfolio diversification. It's not just about having different stocks, it's about having assets that react differently to the same economic events.
That's an interesting point, Michael. It sounds like it's not just about spreading your investments, but also about choosing them wisely to ensure they don't all move in the same direction under similar circumstances.
Exactly, Evelyn. For instance, while tech stocks may surge, traditional manufacturing stocks might not react the same way to a given economic stimulus. Including bonds or real estate in your portfolio can provide a cushion during stock market volatility.
And let's not overlook the role of alternative investments like commodities or even cryptocurrencies in risk management. They can offer unique benefits, but also carry their own risks.
It's fascinating how the investment landscape has evolved. With so many options available, how do investors make the decision on what's best for their portfolio?
It all boils down to one's investment goals and risk tolerance. By establishing clear objectives and understanding how much volatility one can stomach, investors can craft a portfolio that aligns with their financial aspirations and comfort level.
And conducting regular reviews of your investment portfolio is critical. Market conditions change, and so do personal circumstances. What suited an investor's strategy a year ago might not be the best choice today.
That's a great point, Michael. A periodic reassessment ensures that your investments continue to align with your long-term goals, and it allows for adjustments in response to shifts in the market or in personal financial situations.
It seems like an ongoing education and adaptation are key components of successful investing. Keeping abreast of market trends and understanding the dynamics of different investment vehicles can be quite the endeavor.
Absolutely, Evelyn. And let's not forget the importance of historical market data in shaping our investment strategies. For example, studying past market crashes can help us identify patterns and potentially forecast future downturns.
I couldn't agree more, Michael. And with the advent of modern technologies, such as artificial intelligence and machine learning, investors now have tools at their disposal that can analyze vast amounts of data much more efficiently than a human ever could.
Speaking of technology, how do you both view the impact of fintech companies on the landscape of investing? They seem to be making investment more accessible to the general public.
Fintech companies have certainly democratized investing, making it easier and more affordable for people to start. Features like fractional shares, for instance, allow investors to buy a piece of a stock they might not otherwise afford.
However, while fintech innovations have many benefits, they also present challenges, especially for new investors. The ease of use and access can sometimes lead to impulsive decisions without proper research or understanding of the risks involved.
That's a valid concern. Education is key. Utilizing these platforms while armed with knowledge and a well-thought-out strategy can help mitigate those risks.
So, in essence, while the tools and vehicles for investing may evolve, the fundamental principles of due diligence, diversification, and alignment with personal goals remain paramount.
Precisely, Evelyn. And staying informed, not just about market trends, but also about technological advancements and regulatory changes, plays a critical role in navigating the complexities of investing today.
Speaking of staying informed, let's talk about behavioral finance. How significant do you think understanding investor psychology is in developing a robust investment strategy?
It's crucial, Sophia. Behavioral finance teaches us that investors are not always rational, and their decisions can be heavily influenced by psychological biases. Recognizing and overcoming these biases can lead to better investment decisions.
Absolutely, Evelyn. Take the confirmation bias, for example. Investors might seek information that supports their existing beliefs and ignore evidence to the contrary. This can lead to missed opportunities or holding on to failing investments for too long.
And there's the overconfidence bias. This is where investors overestimate their knowledge or ability to predict market movements, often leading to excessive trading and higher risks.
How do you suggest investors combat these biases to make more informed decisions?
One effective strategy is diversification. By spreading investments across different assets, investors can reduce risk and the impact of any one biased decision.
Another strategy is to establish a systematic investment plan. This can help in making regular investments over time, avoiding the pitfalls of trying to time the market, which is often influenced by emotional decision-making.
It sounds like a blend of discipline, continuous learning, and leveraging technology effectively can indeed pave the way for success in investing. Transitioning to options trading, it's another territory where emotional biases can play a big role. Michael, can you introduce our viewers to the basics of options trading and why it's significant?
Of course, Evelyn. Options trading involves buying and selling options contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. It's significant because it can be used for various purposes like hedging risk, generating income, or speculating on price movements of assets.
That sounds like a powerful tool for investors. Can you explain a bit more about how options can be used to hedge risk?
Sure, Sophia. Imagine you're holding stocks of a company and you're worried about a short-term drop in the market. You can buy a put option, which gives you the right to sell your stocks at today's price, even if the market price drops. This way, you can protect your investment against a decrease in value without having to sell your holdings.
It sounds like a strategic move for safeguarding investments. How about using options for income generation?
One popular strategy for that is selling covered calls. If you own a stock and sell a call option on the same stock, you receive an option premium. If the stock price stays under the strike price of the call, the option will expire worthless, and you keep the premium as income.
Exactly. And that's a great way for investors to generate income on their stock holdings, with the added benefit of potentially selling the stock at a higher price if the option is exercised.
Speculation is another reason investors turn to options. Could you elaborate on how that works?
With speculation, investors use options to bet on the future direction of stock prices. Buying a call option allows you to benefit from a stock's price rise, while buying a put option lets you profit from a decline in the stock price. Since options provide leverage, the potential for high returns and high losses exists.
And it's worth noting that while the leverage can amplify returns, it also increases the risk, making it crucial for speculators to have a thorough understanding of the market and limit their exposure.
It's clear options trading offers versatile strategies for investors, but it also requires a solid understanding of the market and risks involved.
Exactly, Evelyn. And this leads us directly into how news and events can drastically impact these strategies. For instance, a sudden geopolitical development can lead to market volatility, which might be a perfect scenario for speculators, but a risky one for those looking for stable income through covered calls.
Right, Sophia. So how should investors adjust their strategies in response to such news and events?
Well, it's all about staying informed and being adaptable. Investors need to closely monitor news sources and economic indicators. If there's an impending event that could impact the stock market, it might be wise to adjust your strategy accordingly. Something as simple as setting tighter stop-loss orders could mitigate potential losses.
And don't forget about the power of diversification. By spreading investments across various sectors, you can somewhat insulate your portfolio from the impact of a negative event that might affect one particular industry.
Diversification is indeed crucial. However, timing the market in response to news can be extremely challenging. Michael, any tips on how to navigate this?
Definitely. Timing the market is tough and often not recommended for the average investor. Instead, look for long-term trends that news events might accelerate. For example, a geopolitical tension that affects oil supply might accelerate investments in renewable energy stocks.
That's a solid strategy, Michael. It emphasizes the importance of understanding the broader implications of news events beyond their immediate impact.
Absolutely, Sophia. And this is a critical takeaway for our viewers. Staying informed, diversifying your portfolio, and focusing on long-term investment strategies can help navigate the complexities of investing in a world where news and events can have sudden and significant impacts.
Absolutely, Evelyn. And remember, while it's important to be aware of news and events, don't let emotions drive your investment decisions. Stay disciplined and stick to your investment strategy.
Wise words to close on. Thank you, Sophia and Michael, for sharing your expertise today. And thank you to our viewers for tuning in. Investing is a journey filled with ups and downs, but with the right strategies and mindset, it can also be rewarding. Stay informed, stay diversified, and always keep an eye on the long term. Until next time, happy investing.
Thank you, Evelyn. It was a pleasure discussing these strategies with everyone.
Thanks for having us. Looking forward to more insightful discussions in the future.